Okay, let's begin. Thanks very much for joining. I'm David Crush, working at CGAP, and Professor Deb Durand is my co-host on this webinar today. We wanted to extend a very big welcome to everybody who's joined today. Good morning, good afternoon, good evening, depending on where you are. Thanks for giving up your time to be with us on CGAP's webinar on microfinance, solvency, and COVID-19, and it's a call for coordination. This is an opportunity for us to hear from and to discuss issues with a wide range of experts from the microfinance community. Let me briefly provide some logistical comments before we get started to help facilitate proceedings. As you can see on the screen, hopefully, audience mics will remain muted during the webinar. And if you want to interact, please do, but do it through the chat function, which allows you to ask specific questions or to make comments. Make sure that you select everyone so that the message comes through to us all. And then what we will do is to try and curate those through the call. And then at the end of the session, we'll be able to bring those comments and questions to the participants on the panel in the webinar. A couple of additional points, as you see on the other logistics, the webinar will be recorded and shared. And the presentation, these slides that you're seeing, will also be shared afterwards. And we just wanted to note that speakers are speaking in their personal capacities, not representing necessarily the views of their organization. Quickly, the agenda. I'm going to make a few opening remarks about the paper that we did, the call for coordination. We'll then move to a series of commentaries from the people who wrote blogs in response to that paper, who are all listed there. You'll see pictures of them later on and see them on the screen. The discussion will then move to getting a perspective, and it'll be a session which is moderated by Deborah Drake, who will be talking with Esther Njoroge of FMO and Anthony Randazzo of the USDFC. We'll then have the forum where the questions and comments that you've raised will be addressed by our various speakers. And then we will have concluding remarks, hopefully by Alexander Sotiriou, who's our a lead at CGAP on this, but he has, I think he's ill at the moment, so he'll do his best to join us. If not, it'll be Deborah who gives the final points. So the technical session, let me start, if I can, by sharing briefly the extent of CGAP's engagement in this area. When the pandemic broke, and in addition to the work that it continues to do on digital cash transfers and the impact of the crisis on financial services customers, CGAP focused on four main areas relating to the impact of COVID on the MFIs, as you can see in this attached slide. So let's lead, if we can read from right to left, start with the policy regulation area. This was an engagement that CGAP had within these higher level policy supervisory arenas. The third area, moving across one over, is the common data, was focused on providing unbiased data that stakeholders, especially the funders, could use to improve their responses to the sector. And part of this effort, we worked with MFR, who are on the call today, on a pulse surveys, stress testing, and with symbiotics as well, a series of briefs, all of which are available on CGAP's website. The MFI resilience piece was also an area that CGAP looked at, including a crisis response roadmap, providing high-level guidance across a broad range of measures that MFIs needed to consider. And then the first part, the funder alignment, which is the main plank that we have worked on and is the foundation of the work we're doing for this particular webinar. We reached out to a range of institutions active in the sector, and these volunteered to join a discussion group with us. This included the US Development Finance Corporation, EBRD, EIB, the IFC, Inter-American Development Bank, IDB Invest, the German government's KfW, Francis Proparco, and the FMO from the Netherlands. And we had a number of calls with them in which we discussed the data we were seeing in the sector, what the DFIs themselves were finding in their own portfolios, with a view to identifying possible supportive, feasible financial structures that might be useful in the future. And we also had meetings with donors, microfinance investment vehicles, partner institutions such as CDI. And we captured the results of these in the white paper, this call for coordination, which is the central plank of the webinar today. lays out the problems as we see them, identifies parties who could help, and it tries to move the financial structuring discussion forward. So the paper was published in late September, and it's been followed up by a set of blogs, each of which has focused on key areas in the paper. And we're delighted to have all of the bloggers here on the call today, and I'll introduce them all individually shortly. So the white paper. This came out of the work that we did with our DFI alignment group. First of all, what we tried to assess was what is at stake in terms of the impact of COVID-19 on the microfinance sector and what it could mean for access to finance for low-income customers who rely upon the services that are provided. Now, the survival of the smaller tier 2 and tier 3 institutions is a very important issue. And these are smaller institutions, often less robustly financed, but they do punch above their weight in terms of the benefit that they provide to low-income populations that they serve. So a sustained stagnation in growth or even widespread failure of a number of these providers could have quite profound and lasting impacts upon customers and communities, and especially if there are no other providers of microfinance that could step in. And Andrée Simone will be addressing some of these issues in her commentary with her experience on the front line. We work closely also with MFR to try and establish how big a financial problem there is in the sector. Early fears of liquidity crises hadn't really materialized, but were there other issues lurking below the surface? Portfolio credit quality problems perhaps being masked by payment moratoria? Were adequate provisions being raised? And Lucia Spaggiari will be exploring this issue in more detail in just a second, and she'll update us on the most recent analysis that's been done. The third thing we did was to try and identify parties who might be able to help, and these included policymakers, regulators, private sector funders, the DFIs and donors. And we tried to identify ways in which each of these groups, with their specific expertise, objectives and resources, might be able to work together to help maintain the provision of financial services to low-income clients. And in this context, we identified what we felt were three key areas for cooperation. And this is the section of making it work. We felt that putting the interest of the microfinance customers at the heart of any joint approaches was necessary. This seems like an obvious thing to say, but it sometimes gets forgotten in the discussions that go on about structures and so forth. Second thing was to focus on creating funding vehicles to catalyze appropriate capital. And we looked at whether a solvency window might possibly be created at the Microfinance Enhancement Facility, which is currently focused on liquidity instruments. We explore whether the IFIM model, which uses long-term donor funding for vaccines, dispersing over periods of up to 20 years, and whether that could be used. This is an interesting model, particularly in the lower interest rate, discount rate environment that we find ourselves in, because future money in net present value terms is still quite substantial. So we looked at whether there are ways to use that to underpin solvency enhancing instruments. And then we, not unrelated to this, we argue for an expansion of a range of possible investment instruments, not just straightforward equity to help shore up solvency, but redeemable pref shares, long-term subordinated debt, convertible debt, and at the same time, even an increase in the availability of local currency denominated debt. And Deborah Drake will be, another one of our bloggers, will be speaking more about this shortly as well. In all of these, donor support we felt would be crucial. It's also true that consolidations of institutions might be required in the industry, and the results of some of the restructurings, and Mary Rose Brusewitz will explore issues related to this in her presentation. So the conclusions of the paper are the following. We feel that a regional approach makes most sense at this stage. As you'll see from Lucia's presentation in a minute, there are significant differences in how this crisis is unfolding in different places. Our sense is that sub-Saharan Africa would be a good place to begin with. And second, we think there should be a shift away from traditional debt and liquidity responses to more of a support for the capital bases of microfinance providers. And the DFIs could play a key role in this. And thirdly, and finally, we can't emphasize enough the importance of well-structured donor support in this area. But we shouldn't be sitting back and expecting traditional grant finance just to appear. We need to help build the types of leveraging structure that makes best use of this scarce resource, including blended finance structures, finance to support measures for microfinance providers to build stronger delivery models. And this would include much greater digitization of the services they provide. And it's quite clear that providers with strong digital models seem to have been better able to deal with restrictions placed on them by the pandemic. And our final two bloggers will talk about this particular issue. Sizwe and Mdluli from CGAP, about some of the benefits that can be achieved through well-crafted digitization strategies, and Nina Fenton from EIB about what DFIs in particular can and have done in this important area. So this brief overview then opens the technical discussion. Let's now turn to our bloggers, who you should be able to see on the picture there. Let me ask Lucia now. She can take us through her and MFR's analysis of what the data seems to be showing us. Lucia Spaggiari is the Innovation Director at MFR, which is the Microfinance rating agency. And she's been providing very clear-eyed analysis for us in the DFI alignment group over the last year or so, and it has been super helpful. So Lucia, if I can hand over to you.
Thanks a lot, David, and good morning, good afternoon, everyone. It's a pleasure to be with you. Today, we will see emerging trends in credit and solvency risk of financial service providers in the financial inclusion space. To do so, we explore the combined database constituted by the CGAP Pulse survey conducted in 2020 and the Atlas data platform, including 2021 data as well, for a total of 581 financial service providers in 2021 or 2020 of different types, different charter types, regions, and sizes. Please keep in mind limitations of data analysis that also apply in this case, including data availability, which is higher for historical periods and lower for recent quarters, because we are still in process of completing the data collection for 2021. Reporting bias is always possible because some of the most affected FSPs may discontinue reporting, and please always keep in mind that the aggregate analysis that we will shortly share is good for helicopter view, but it never replaces the very relevant individual FSP level analysis because each case is different. With these limitations in mind, let me share the results in a nutshell. Emerging trends are positive on the credit risk side. We see a decrease globally in credit risk in 2021, driven by a decrease in restructured portfolios. The picture on the solvency risk side is more mixed. To analyze solvency, we look at both what the equity to asset ratio can tell us and at what the equity to asset can't tell us yet. The equity to asset shows a positive or slightly a stable or slightly negative trend from 2019 to 2021, but we do not observe dramatic changes. And the range of financial service providers in a solvency risk zone remain in the range of 21–24%. What is important to keep in mind is that the equity to asset ratio is not sufficient to assess the future solvency risk because the full cost of the credit risk generated in the past couple of years may not yet have been incurred as an expense on income statements. We see that the provisions for loan losses have increased, but less than credit risk, and the proportion of assets at risk not covered by loan loss reserves as a proportion of equity has increased, and it is today from 5 to 6 times higher than in normal times, constituting an additional component to the future solvency risk of financial service providers. As you know better than I, there are many factors additional to COVID-19 that may have an impact on future solvency in emerging countries, but 2 other factors that will determine the future of solvency in this industry are clearly portfolio yield and the capacity to recover pre-crisis levels, as well as the capacity to reduce credit risk and return to levels of credit risk coverage similar to pre-crisis without the need of incurring in large provisioning expenses. Let us now look at the data closely. What you see here as a rose line is the total credit risk ratio, composed of PAR 30, restructured portfolio ratio and portfolio under moratoria, as well as write-off ratio. This is the ratio that allows comparing financial service providers with different write-off and restructuring strategies. So it is very positive to see that after the very high increase in 2020, the credit risk ratio is decreasing to 10% in 2021, even if we are still higher than the baseline. This decrease is due to the decrease essentially in the restructured portfolio ratio, which is positive in that it decreases the uncertainties regarding whether the restructured portfolio will transition to PAR or to performing portfolio. At the same time, the restructured portfolio we remain with may potentially have higher credit risk than the 2020 restructured portfolio if these are the loans with the higher default likelihood that we keep on in the restructured portfolio. All regions display an improvement in the credit risk ratio. The improvement is less significant in South and Southeast Asia due to still high levels of restructured portfolio, while in Latin America and the Caribbean, we see that the improvement in credit risk is driven by a decrease in the restructured portfolio. Looking at Sub-Saharan Africa, we still see that the key component of the credit risk ratio in this region is portfolio at risk more than 30 days. Let us approach the solvency question by segmenting financial service providers into three categories: acceptable risk or high solvency risk, depending on how their equity to assets ratio compares with simplified solvency thresholds, depending on the size of financial service providers. The trend in the share of FSPs by solvency risk category is pretty stable over time. We saw a deterioration and an increase in the high risk category in 2020 that does not seem to be confirmed as a trend in 2021 data so far, even if the full 2021 fiscal year data would be important to confirm such a trend. The transition matrix shares a similar message in that the strongest predictor of recent solvency risk is the solvency risk at baseline. There is some movement of FSPs in different categories of solvency risk, but such movements are moderate. This being said, the equity to asset ratio is not sufficient to tell the full story of future solvency risk. And this is because the cost of credit risk that has already been booked in income statements may not in all cases be commensurate to the full increase in credit risk that is seen. To analyze this additional factor of future solvency risk, we can look at the amount of credit risk that is not covered by loan loss reserves as a percentage of equity. This is the PAR 30 plus restructured minus reserve over equity ratio. This is a ratio that was around 1% at baseline. It increased sharply to 11% in 2020, and positively, it declined in 2021. The fact that this ratio in 2021 is different than at baseline means that the increase in credit risk has been higher than the increase in the reserves to cover credit risk. And the amount of the ratio is an indication of the component to the future solvency risk resulting from the gap between credit risk and provisions to cover such risk. So in 2021, we are seeing levels of credit risk uncovered by loan loss reserves, which are from 5 to 6 times higher than in normal times. This is due to several factors. It is a result of provisioning requirements that have been relaxed by regulators. It is a result of strategic decision-making to balance prudential financial reporting with the need of preserving results and solvency in the short and medium term. We can see the same trend in terms of segments of financial service providers by solvency risk. Here we see the credit risk ratio by, in red, financial service providers with high solvency risk, rose, financial service providers with solvency risk, and gray, financial service providers with acceptable solvency risk. And what we observe, for example, for the high risk segment that confirms the high risk appetite of some cluster of FSPs is that a high increase in credit risk was accompanied by the lowest increase in the provision expenses. Provision expenses increased in 2020 across all categories, but less than credit risk increased. So
Lucia, I wonder if we can, at the end, come back to some of these particular issues. I'm sure people will have a lot of questions about it. I'm just a little conscious of time, and I wonder if I could move across now to bring in one of our other bloggers. Is that okay with you?
With pleasure, David.
Great, thanks very much indeed. So we can come back to that. If you've got questions, please put them in the chat section, and then Lucia can pick those up later on. I wanted to turn now from the data to the front line and to bring in Andrée Simon. She's president and CEO of Finca Impact Finance and has a long history of engagement in the sector. And she will share with us her experience of the pandemic, underlining, as she does, why it's so important for the microfinance sector to be supported going forward. So Andrée, over to you.
Well, thank you so much, everyone, for inviting me and for creating this chance of this discussion. I'd like to start with, what I see as the real point, which is the clients. And I so appreciate that the white paper in particular really made sure that we kept the focus on the clients. The statistic that we all quote, going back to the Findex, is that there are roughly 1.7 billion people that are still financially excluded. And that's a conservative estimate because we know that even though we've made a lot of progress in getting people access to digital wallets, et cetera, that they're still underutilized. We use that data point as a proxy for all of us who are focused on financial inclusion in terms of what we're trying to achieve, which is gender inclusive, financial health and resilience at the bottom of the pyramid in order to achieve more stable, healthy and productive societies under conditions of profitability for our stakeholders. We know that COVID has seriously stressed our ability to achieve that goal. It has pushed many of those who are financially marginalized deeper into poverty. It's pushed many entrepreneurs who were able to escape poverty right back into it. We see the tangible evidence of that in our portfolios. We have data that shows that even though 80% of our clients wanted to and intended to pay back their loans, many of them have simply been wiped out. And in some countries, many of our clients cut down on the number of daily meals that they were eating just to make ends meet. We see the hard evidence of that passing through into that excellent MFR analysis that Lucia just took us through. And microfinance providers and our key partners, Mary Rose and Deborah both made reference to the dialogues with the lenders and with the equity investors. We've had to work incredibly hard over the last 2 years to divvy up the pain of that wipeout in order to not leave the clients behind. And we're getting a lot closer, in my estimation, to having absorbed that pain. And I see lots of reasons for optimism as we move forward. But the data that we just went through shows that there is still a lot of work to be done in terms of absorbing the shock of COVID. And it's going to take a lot more collaboration before we're through. If we do it right, we're going to minimize the number of people who are kept in or pushed back into poverty. So the big question, I think, for all of us as we move forward, and there are lots of excellent recommendations that have been made in the paper, is, okay, but what do we do now as, in my case, FSPs, but as an ecosystem in this context? I will start my pivot here by saying that I absolutely love technology. My team has been working on transforming our business model to make it more digital. And without a doubt, the fact that we progressed so far was one of the main factors that has helped us through the pandemic. Over 50% of our transactions network-wide are now managed through non-branch channels. In countries where digital literacy levels are relatively low and the trust in banking systems is low. But I will counter that by saying that most of the technology solutions that are there are not yet fully relevant to the current needs of most of the clients that we serve. That's particularly the case in sub-Saharan Africa. So David, I'm really glad that you flagged that, where the costs and reliability of data are still too high. They're going to get there. And microfinance providers have to leverage technology more to deliver greater efficiencies. But for the foreseeable future, we do have to, as an ecosystem, make sure that those individuals, especially women who are marginalized, have continued access to services that build their financial health. Microfinance delivers gender inclusive financial impact at the bottom of the pyramid. And with further investment, particularly capital support, and by leveraging technology, it can deliver even more. As the CEO of a network that operates in many of the most volatile, difficult markets around the world, I can attest to the fact that we can achieve real social impact and real financial inclusion under conditions of profitability. But there are major challenges in this calculus that we have to work together to solve. Clearly, scale is an issue, FX risk is an issue, exits for investors, political risk, and of course, climate challenges as those external shocks that come. But the only way out, in my view, is through. It's through with these partners that we have on this call who accept that there is a cost to building the future that we want. My vision for Finca is the future as a digital bank that supports a community of clients in building their financial health. I want to lead how we define responsible financial services in a digital age. But I also know that we can't tear down the bridge our clients are standing on before that destination is in sight. We have to really continue to work very closely together with both the lenders and the regulators and the investors to address the needs of our clients today. And I am very much looking forward to this dialogue. Thank you.
That's great. Thanks very much, Andrée. What do we do now as an ecosystem? It's a key question, and hopefully we can make some steps towards answering it. Now, if we're going to keep relations between microfinance providers and their financiers on a sound footing during troubled times such as this, then what sorts of aspects need to be addressed? We turn now to lawyer and impact investing specialist, Mary Rose Brusewitz, who's a member in charge of the New York City office of Clark Hill PLC, who's going to share with you some of her guidance on the tricky issues relating to restructurings and related points. Mary Rose, over to you.
Thank you, David, and thank you to CGAP and David and Deborah for basically providing all of us with an opportunity to share perspectives and to get some perspective. I think, as David has noted and Andrée has mentioned as well, I like to be mindful of the people who the tier 2 and tier 3 MFIs actually serve, and to keep in mind, why we're all at the table. At the inception of the pandemic, a lot of MIVs got together. They perceived that the pandemic was going to present challenges to the sector, and they did think through an MOU and make a pledge to try to support the industry. However, now we're moving into 2022. And in many cases, we're still engaged in what may seem to many like endless negotiations. The pandemic and the impacts of it have really presented challenges, as noted by Lucia and others. The data on which we can base feasible restructuring plans continues to be a challenge. There are challenges in some markets that are producing liquidity issues in terms of the ability to get new funds for the MFIs to go ahead and continue to grow their businesses. Sometimes there's some government support that could be there that isn't necessarily there. And I think what I'm perceiving in the market from the ground is that there's a lot of impatience and trust is sort of wearing thin. I think that this is exacerbated by the fact that we can't always meet in person. And so the way we're structuring the dialogues, maybe we should sort of work on that. I also wonder whether we shouldn't have had some sessions with some of the borrowers early on about how does a restructuring actually work? What are the phases? What are the expectations? Because I think sometimes the MFIs have been faced by this terrible crisis that they don't know how to face. And maybe we should have counseled them a little bit more. And maybe we should be polling them now to see what we could learn to do better. So the challenge now is to how to convert short-term temporary measures like standstills and payment deferrals to more permanent restructuring so that the borrowers can go back to the mission. We still are unable in many cases to really allocate the risks and the burdens. And I think what this all points out is that restructuring is a really resource hungry process. And that some of the things that have led to the restructurings were exacerbated by COVID, but probably there were weaknesses that we could have addressed when we're going in for new deals. And so one of the things that I hope we can do is to keep in mind the lessons learned and really try to give tier 2 and tier 3 MFIs more resources like technical assistance when we do spot in the underwriting process weaknesses, whether it's information systems, ability to handle crises, and the like. And so those are some thoughts that I had.
Oh, that's great. Thanks very much, Mary Rose. Given the weaknesses that you've identified, assuming that restructurings can be put in place, I guess the next set of issues relates to sound financing for the future. And here we look to our other blogger, Deborah Drake. Deborah is VP for Investor Engagement and Research at the Center for Financial Inclusion. She also directs the Financial Inclusion Equity Council, which links private entities to equity investments in the developing world. So she's going to share with us some of the lessons she's learned about the importance and difficulties of attracting equity capital into this key sector. So Deborah, over to you. Thank you.
Thank you, David. And it's a pleasure to be here and sort of pleasure to be following Mary Rose to sort of build on her comments about restructuring and debt investors. And what I want to do now is to really point out some of the factors behind how equity investors behave. Because I think there's sometimes a confusion between debt investors and equity investors, and they're sort of all lumped together. And you know, the big question is, why aren't equity investors doing something now? And I think, you know, it was important, obviously, for the debt investors to move quickly and sign the MOU to work together, because obviously there was outstanding liabilities that needed to be negotiated. What we're seeing now, and I think we didn't know back then, is the extent to which this could potentially be a solvency crisis and not a liquidity crisis. And as Lucia has pointed out, you know, we're seeing some indications of some difficulties out there. And I think, as Mary Rose also said, I think what we have seen also as equity investors is that those institutions that were having some difficulty prior to COVID are the ones that seem to be having more difficulty now post-COVID. But, you know, what about the equity investors? Well, what's going on now is that, the equity investors have been working behind the scenes, trying to figure out exactly what the conditions are of the institutions, their investee institutions, as well as looking forward in terms of, where are those investee institutions going, and then what about new, institutions, new pipeline. Everyone's anxious to get moving again, and the inability to travel has obviously impacted that. And I think, the number one challenge that has been out there has really been the fact that nobody really knows exactly what is going on in terms of what these institutions look like financially because of all of the moratoria and the easing of restrictions and the lack of clarity about accounting treatment. And as Lucia said, when is there going to be some kind of a regulatory reckoning as to writing off these loans or having to provision more, et cetera. So not knowing this sort of muddiness of data, it's not necessarily a lack of desire to provide the data. It's just that every country is different in terms of what they're requiring their financial service providers to do. And the role of the regulator is key in this, and talking about an ecosystem. So when you don't know exactly what's going on and you're unclear about the trajectory of the institutions and the financial sector in general, you probably are going to sit around and wait a bit to see what everybody else is doing. And so I think that's what we've seen a lot over the past year. There's a real desire on the part of the equity investors to figure out where they can provide, what do they need to recapitalize, and why are they going to recapitalize. So I think it's just important to understand that equity investors do operate differently, that they have different structures, and some equity investors may not be able to provide additional capital because they may be in a kind of structure called a closed-end fund that has already issued a specific number of shares and has a lifespan, and therefore can't necessarily disperse more money because they are coming to the end of their life. So I think it's important to understand what kind of equity investors are out there and what their capabilities are going to be in terms of dealing with potential recapitalization, or, as someone had mentioned earlier, possible consolidation. Now, I think, possible consolidation is out there, but again, going back to the world that we're in now, that is much more digital, and as Andrée pointed out, the idea of potentially jumping in from an equity investor to purchase a microfinance institution that has a lot of branches may not be the attractive option that it was many years ago. So you have a question of how consolidation is going to take place, and is it going to be perhaps in the form of just the sale of a portfolio versus the acquisition of an entire branch network. But I think I just want to end with saying that the desire is there. There are more innovative ways of looking at, like, how do you do an investment now when you don't know quite how to value the institution? And so, are there things like deferred pricing agreements and things that will allow you to move forward? And if you're an equity investor, you have to respond to your investors. So you have to be able to know, what is going to be acceptable. And certainly there is a desire to look for other potential options to continue to support the sector. And I'll stop there.
Thanks very much, Deborah. That's really helpful, explaining perhaps where are the equity investors, uncertainties, and so forth. People, you focus on the challenges, but I guess people need also to remember that there are opportunities there as well. And you mentioned digitization. So I guess the question is, how do we help to bake in the efficiencies that can boost sustainability and the potential for stable financial returns in the future? You mentioned digitization. The next speaker we've got is CGAP's own Sizwe Mdluli, who will share with us his expertise in this particular area. Sizwe works on the modernization of government-to-people payments, as well as MSE financing, and he was previously at the IFC, has long experience in financial inclusion and access to finance. So Sizwe, over to you.
Thank you, David, and thanks, everyone. So from our perspective as CGAP, in addition to calling for coordination within the funder sort of domain, We are also calling for microfinance providers to reimagine the way that they are approaching digitization, because we think if and when it's done well, it doesn't just improve the odds of survival for that individual microfinance provider, it also does the same for the sector as a whole. And more importantly, it improves the resilience for the people that microfinance providers serve. So we like to think of digitizing not just for its own sake, but rather with a clear goal to bring value, not just to the institution, but also value to the customer. We see digitization that brings value to the customer as a way of helping the customers become more resilient. Everyone, I mean, on this call, I think understands the value of digitizing for customers in terms of affordability, accessibility, suitability, and if done really well, the improvement of the experience around accessing financial services. But when that's done well and the customer is satisfied in using the products and accessing them in the way that they want to and where they want to, it can also help improve the bottom line of the financial institution by helping them do more, so scale, and also possibly doing it better, efficiency. Now, what we've done as CGAP is to go out and look for examples of digitization done well. We've then produced a paper on this. It's called Digitization in Microfinance, a Case of Study of Pathways to Success, which looked across the globe at institutions that had digitized in some fashion, with value in mind for the customers and also for the institution. We came up with 5 institutions: Bankamia in Colombia, Amret in Cambodia, Finca Impact Finance, Microfund for Women in Jordan, and Al Quraimi Islamic Microfinance Bank in Yemen, who have done this relatively well. And in so doing, even during the pandemic, have seen improvements in the use of channels, improvements in the use of or adoption of products by their customers. And this has translated into improved transaction volumes, and in some instances in the double digits. But what the pandemic has shown us is that it's not just important to digitize, it's important to do it quickly as well. So we are championing an incremental and agile approach to digitization that is focused on 2 things. The first being identifying and capitalizing on low-hanging fruits. And then the second is using this minimum viable product approach, which gives you the opportunity as a microfinance provider to continually incorporate customer feedback into your product development. We think that funders can help accelerate the move towards a focus on low-hanging fruits and this minimum viable product by also focusing their support, especially in this solvency context, towards those institutions that are willing to commit to an approach that is for the low-hanging fruits and for minimum viable products. Now, MFIs or microfinance providers themselves can also help themselves in this context by also being able to measure the value that they create and to do it transparently in order to make it easier for funders and investors to better understand the value that is being produced for themselves and for their customers. So what is CGAP doing generally to try and push forth this new approach or this reimagining of digitization? The first thing is we are helping to define this new narrative around focusing on value. We are helping to illustrate cases of success. We are also trying to steer providers away from repeating the mistakes of their predecessors by talking about failure and what to look for when you're digitizing so that you don't have the same failures. We are also looking to help providers measure value. And we are also looking to help providers identify low-hanging fruits. And finally, we are looking to create a community where providers who have questions about digitizing, they are interested in doing it, but are not sure where to start or how to go about it. We are creating a forum or a community of practice where providers can come together to do that, so that at the end of the day, they can be more resilient and they can in turn pass on that resilience to the customers that they serve. So thanks, David. I'll maybe stop there.
Great, thanks very much, Sizwe. So opportunities do exist, and digitization is clearly crucial for the future, not just doing it quickly, I guess, but doing it safely as well. So it needs to be combined with effective customer protective regulation to reduce the digital risks of things such as over-indebtedness and all the other dark sides of the digital revolution. So how can we support good digitization? Nina Fenton, who's senior economist at the EIB, provides our final set of comments in this section of the webinar. Nina has a doctorate in economics from Oxford University in the UK and extensive experience in the international development finance segment with 3 of the largest IFIs, World Bank, Asian Development Bank, and the EIB. So Nina, what can you tell us about the DFI involvement in this key area for microfinance providers?
Thank you very much, David. So I'm really happy to join today. We actually partnered with CGAP, including with David and with Henry, to analyze the microfinance sector in Africa for our recent publication on finance in Africa. And I'm really happy to have the chance to discuss a little bit today some of the issues coming out of that, because digitalization was an area that we focused on. I'm going to focus on the digital side because that's, the topic of the blog. But I just wanted to say that, I think this is a really timely discussion. A lot of our analysis, it was done a bit earlier than the work that Lucia has talked about. So it was great to get an update from her today. It's been quite sobering, and I think it's very timely to get together and think about how we can work together and coordinate to best support the sector. And of course, digital is just one part of that equation. So I agree with a lot of what Sizwe just said. So we've seen, as he said, that digital finance has really supported resilience during the crisis. That the microfinance institutions and also banks that were already using digital channels were more resilient, that they were able to keep serving their customers. And we believe that it has massive and unexploited potential to support financial inclusion also in the aftermath. I mean, we've seen that technological innovation can help to reach out to underserved or unserved groups by bringing down costs and reaching remote areas. And I think it can also help with some of the risk issues that we see in the sector and that have become, really come to the fore during the crisis. And I think this is what Sizwe was alluding to. For example, we've talked a lot about data today. And the importance of really understanding what's going on. And I remember in the early days of the crisis, starting to talk to David and, what are the data that are available? How can we understand this? We're looking at the Global Pulse survey. The more that the monitoring systems of the MFIs themselves are digitalized, the more that financial flows are going through digital channels, the quicker the financial institutions are going to be able to see what's happening on the ground, how their portfolio is evolving, and they're going to be able to react. It's also super important for investors, for the EIB and others. The one thing that investors hate the most is uncertainty. The one thing they want to know is what's going on, how can we react, how can we address this, how can we mitigate risk. At the same time, I think we see the use of digital finance can help deal with some of the structural barriers that actually explain, why we even had an issue of financial inclusion to start with. Increased use of digital finance can help bring financial flows into a formal system. It can be used with alternative credit rating methods to provide a route for formerly excluded groups to build up credit history. So there is, basically tons of potential there. So what can DFIs and IFIs do to support and make sure that, we really make the most of this potential and address some of the risks? Of course, the most obvious area is finance. DFIs and IFIs are providers of long-term patient capital. We're able, using blended finance, using guarantees that we can draw on to support innovation, to take some of the risks, to look ahead, using different tools and instruments to fill market gaps. And this has allowed us to support, for example, venture capital funds, which have been a really important source of finance for fintechs in Africa and elsewhere. But I think we also need to perhaps do more now to support some of the traditional finance providers, including MFIs, as they go about the digital transition. We know that was led by non-bank institutions, but we've seen during the pandemic, we did a survey of banks across Africa, and an overwhelming majority of them, 9 out of 10, said that they've been pushed to accelerate digitalization of their offerings. They want to respond to their clients, and I think this is also true of the microfinance institutions, and we should be ready to support that shift. And to make sure that it's done in a way that also preserves, the benefits of the industry in terms of client protection. And I think this is really important because digital is just a tool, right? So we shouldn't be focusing on the fintechs as some kind of, new and amazing solution to everything. No, fintechs are using a tool to reach out to a new group, but microfinance institutions have a comparative advantage in understanding their clients, in reaching these underserved groups. And if we're able to help them to, transition to be more effective using digital tools, then they're going to have a very strong offer. And that will help us to really take this sort of client-focused approach, really to get the benefits for financial inclusion. Of course, there's a lot that we can do in the background, complementing the actual financing of these solutions by supporting the infrastructure and the skills. So in the blog, we highlighted some of the support we've given to digital infrastructure in Africa, and that's becoming a real focus for the EIB. We're also working a lot with our clients, on financial and technical literacy for the final beneficiaries, and also helping them, to understand what it is that they need to put in place to make this work for their clients. Some of that is through TA, some of that is through trainings, and a lot is also through peer-to-peer learning, because this is such a rapidly evolving area that, a lot of the banks and microfinance institutions have a lot to discuss with each other about what works, and as Sizwe said, what hasn't worked. And recently, I attended a couple of our banking and microfinance academies, and some of the most interesting discussion was the interchange between, some of these institutions, what they're doing, and what has worked out, and where they can go with this. And of course, finally, we have to keep working with the clients and with the regulators and other authorities to make sure that the risks are addressed. And I think IFIs and DFIs have a strong role and a strong voice there. Both in terms of risks that might happen at a kind of macro systemic level, and risks that come up at the client level. The issue of client protection has to really remain to the fore. So I'll stop there, but thank you very much. And I think I've learned a lot, not just on the digital today, but on some of the other issues that are coming out in the sector. And I hope this cooperation can continue going forward.
Thanks very much, Nia. That was a really interesting analysis of the issues, and particularly struck by your comment about you've got the institutions and you've got the potential financiers. It takes two to tango. Banks need information about their clients. Digitization can help in the terms of providing up-to-date, good information. So that brings us to the end of this first session. Lots of interesting issues raised, lots of challenges and opportunities surfaced. I'd like to hand over now to my colleague, Professor Deborah Drake, who will be speaking with Esther Njoroge of FMO and Anthony Randazzo of DFC, both of whom are, of course, speaking in their personal capacities. So thanks. Deborah, over to you.
Thank you very much. And I'm delighted to be able to continue this conversation now. And I'd like to bring Anthony and Esther into this. So if we could have their faces highlighted, that would be fabulous. And what we're going to be doing in the next 15 minutes is, and Nina did a nice job of starting to tee this up, is to hear a little bit from how some of the diffies think about these things. But let me give an important caveat, because we really prize the insights that Esther and Anthony and folks like them have within these institutions. I've asked them today to give their personal views. They are not here representing their institutional particular point of view, but they're certainly, their thoughts are informed by their long histories and experiences with these two organizations, FMO and DFC. And they have sat there thinking about when to make investments, how to structure investments, and respond to the mandates of their organizations. So with that, Esther and Anthony, I'd like to pose a question to the two of you. You've read the blogs, you've just heard these really interesting sort of summaries of them. Which themes from the blogs and the white paper resonate most with you, and what do you think are the most important questions for us to be focusing on at this time? And I'll start with you, Esther, and then to you, Anthony, and just sort of give us sort of, where do you think our attention should be focused?
Sure. Thanks very much. And first of all, thank you for having me in this discussion. I've truly enjoyed reading the blogs and just following the discussions. And, you know, when I was thinking about your question, I listened very keenly to what Andrée said, and I echo her comments in saying that I too love digitalization. And I'm very happy to have seen that, you know, how much has changed in such a short time, and in response to an event that was unforeseen. You know, we've seen MFI players, you know, being forced to digitize or to even accelerate already existing plans to do so. And this is great. You know, higher financial inclusion for people is exactly what we need. And digitalization plays a very crucial role here. And what I find very interesting in the entire discussion is that with digitalization comes very interesting sets of challenges. You know, to highlight some that have already been discussed, the cybersecurity questions, you know, furthering inequalities in some instances, especially for marginalized people who do not have the financial literacy and the access to internet and the access to, you know, services that would allow them to access digital services provided. But something that really sits close to me is the question of consumer protection, because at the end of this entire digitalization journey is the consumer. So if there is any way, you know, to recognize that with digitalization, the opaqueness of consumer protection is highlighted even more, and transparency around pricing, around structures, around, you know, repayment requirements become, you know, they're put more so into the limelight. And I recognize that CPP procedure changes are not happening as fast as they should, in my view. You know, we are chasing consumer protection as opposed to consumer protection leading the way. And that's the question that I think still remains as we continue with the discussion of you know, the impact of the pandemic on MFIs. And this new wave of the relevance of digitalization is, can procedures and policies lead as opposed to lag as far as what we have seen? Can they be less static and more robust? And if they can, how? And how can we actually play a more steering role in that? There's a lot more, but I really wanted to focus on the concept of digitalization and the impact that it would have on consumers.
Thank you, Esther. That's important questions that you're raising, particularly if the heart of what we're talking about today is how is this all impacting the customer. Anthony, what were some of the themes that came out of the blogs or the white paper that you think have raised some questions that we should be paying attention to?
Yeah, thank you for inviting me to speak today, and I really enjoyed reading the blogs and appreciate the opportunity to comment on behalf of the DFC. I think, you know, I agree with the main conclusions of the CGAP paper, the call for coordination, the main conclusions being, you know, keep the customers front and center as we work through this, and, you know, creative solutions are needed. And I think definitely blending different types of capital together from DFIs, from donors, and from the private sector is really the way to go. And I'm going to echo what Esther just said, which is that of all the blogs that really had an impact on me, I think Andrée Simon's was the top of the list. And she asked some important questions. Is microfinance worth saving? And should MFIs be allowed to fail to make way for fintechs? That wasn't a question she posed, but there was some implication that some are suggesting that. And I think she does a good job of responding to those questions, yes to the first and no to the second, because microfinance is irreplaceable and serves the needs of the poor and fills a gap that's not being filled by others. But I think, more importantly, I don't think that fintech has really lived up to its full potential in many cases. And we've seen examples of irresponsible behavior where they're charging even higher interest rates than traditional microfinance institutions and contributing to over-indebtedness and high rates of default. And so, as Nina was saying, it's a tool. Technology is a tool. And, it has the ability to dramatically reduce operating costs by eliminating cash, by eliminating paper, and even to a certain extent, eliminating humans from the credit cycle. And this in turn should enable financial service providers to really dramatically reduce the operating costs, which has always been sort of a problem that microfinance institutions have traditionally faced. And I think that, this reduction in costs should enable traditional microfinance institutions to reach previously unbanked clients that were too expensive to reach, but also take those cost savings and, lower the costs of interest rates to pass those savings costs on to the borrower in the form of lower interest rates, those that are currently banked. And so, rather than sort of this Darwinistic competition between fintechs and microfinance institutions, I've been following fintechs for a while, and I felt like rather than competition, there should be a sort of convergence between the two camps. On the one hand, microfinance institutions should be adopting sort of the best elements of technology to lower their costs and to pass the savings on to their customers. And on the other side, fintechs, becoming more responsible players, or in fact, we've seen examples of companies that where fintech is a platform and is a fee-for-service provider for traditional financial service providers and offering their platforms to originate credits. And so we have seen some evidence of this convergence, and hopefully that's the way it will continue to move forward.
Thank you both. And I'm going to pick up on something that Anthony said and maybe shift us a little bit in this conversation. And Esther, Anthony made reference to the importance of blending capital. And what role do you see blended finance? First of all, what do you think of when you hear the word blended finance? But what role could it play in responding to potential insolvency crises, both to forestall a crisis like this or to remedy it when it happens? And I guess there's a real important issue there with blended financing, which is just it's aligning a lot of different interests at the table. So I'd love your perspective on blended financing here as a tool.
Sure. So first of all, I recognize that there is no unified definition for blended finance. So in my stance, I see blended finance as a strategic use of public development finance with the aim of mobilizing additional private finance towards sustainable development. So, the bottom line is that there is this pocket of, public development finance that's available, but it is only helpful and relevant if it can mobilize private finance, because it is finite, and the room and the space that is there is actually for private players to play. So the whole idea of blended finance in my head is to just take that first step and create an enabling environment for private players to come in and even take a greater step and, inject even more and take an even bigger role across the board. So I recognize that there's need for equity investors to come into play to forestall and even remedy, solvency questions. We do need debt funders. We do need, donors. But what blended finance can do is to use its somewhat flexible nature to define new ways of working. So I see a scenario where, as now we are having a lot more clarity on the insolvency questions, which comes very close to the liquidity question that was there, earlier last year. And I see a scenario where lending stalls, MFIs and FIs decide this risk is not worth it, and we will just not lend anymore. And that in itself, in my head, is actually a self-fulfilling cycle. So you do not lend, you have a poor balance sheet health, you have poor balance sheet health, you do not lend, right? And that's where blended finance, in my view, comes in. You can use blended finance to go as far as to provide risk-sharing instruments that go beyond the typical 50-50% risk-sharing guarantees that are out there that are used to mobilize lending, going as far as taking, a second loss stance of up to 95% from a portfolio level, and having MFIs and FIs only stomach the 5% loss. And what comes with that is that lending is accelerated. And this cycle, because to me, if we do not keep MFIs working and FIs working and supporting the sectors that they are playing in, this crisis will arrive much sooner than we see it. And that's what I see blended finance doing by coming in and creating a new way of doing things and a new way of seeing the risks that are ahead of us, and using that to catalyze and mobilize other private players to now give the equity investments that we're talking about, to give debts as an instrument, subordinated or so, to the MFIs that are in this space that we are in. And hopefully, in the end, we can all actually enjoy the fruits that are born from this collaboration that is led from the front by blended finance outfits.
Thank you, Esther. And Anthony, I could see you nodding at times as Esther was talking. And maybe we could take just sort of the last 3 or 4 minutes that we have of this portion of our conversation for you to talk a little bit about the challenges you see should the microfinance sector start to consolidate. And related to that, Esther has called out, as did Deborah Drake and others, the role that equity plays in this, and what are you expecting of equity investors at this point in time? So I'd like to hear your thoughts about a consolidation and the role of equity.
Sure. No, and let me start by echoing what Esther just said. I think, if there is a crisis looming in terms of insolvency of microfinance institutions, then a blended finance structure is really, I think, super appropriate for addressing this challenge. And I think blended finance structures really work well when 3 conditions are met. One, there has to be catalytic capital that's willing to sort of not earn a fully risk-adjusted return. So there's a degree of subsidy involved. Second, both sides, the catalytic capital and the commercial, need to be motivated by sort of this win-win, see it as sort of a win-win for both sides, because they can each make a larger investment or achieve more impact than they could achieve on their own. And third, and this is the point I wanted to make, is that the risk has to be perceived as really high and difficult to quantify. And I think that's the situation that we are in today. Normally, blended finance, we talk about using them when there's a new sector or new business model that hasn't been tested. And so there's that perceived higher risk. But in this particular case, the higher risk is due to the pandemic, right? And the fact that it's created a lot of uncertainty in terms of portfolio quality. It's created a lot of uncertainty in terms of how long is this pandemic going to last? How are we going to exit from it? How quickly are we going to exit from it? How quickly will those portfolios start to recover? And so because of that perceived high risk, I think a blended finance model is particularly appropriate. And I think to your question specifically, what will happen in terms of consolidation? I think, again, going back to the call for coordination, I think it's really important for us to be responsible investors and make sure that we keep the interests of the clients front and center. I think to Deborah Drake's point, mergers and acquisitions are very challenging. It's very difficult. And so that may not be the best approach. I know of one major microfinance network that a couple of years ago embarked on international expansion strategy, and they raised the capital, and the initial strategy was to acquire microfinance institutions. And after acquiring the first one, they quickly abandoned that approach and started working in greenfield investments. And I think it speaks to the challenge that you face in terms of corporate cultures, in terms of legacy legacy information systems that are really difficult and challenging to absorb. And so I think, to Deborah Drake's point, I think purchasing portfolios might make more sense if consolidation is needed. And I think, not just purchasing the quality portfolios, but maybe there's an opportunity here for a blended finance structure to purchase some of the non-performing portfolios as a way to remove them from the portfolios of the microfinance institutions. That would probably require a lot of financial alchemy, but I think that might be another approach to creating the certainty that those MFIs need, that investors need, and do it in a way that the regulators recognize that that's helping to clean up the balance sheet and to bring some certainty and bring some clarity to a situation where there's not a lot of clarity and there's a lot of risk.
Thank you very much. And what I'd like is I want you to stand by, because we're now going to open the conversation for all of our speakers and start integrating some of the questions that have been coming up in the chat room. So David, do you want to give some guidance to folks about how we're going to handle the next 20 minutes before we end this?
Sure. No, thanks very much. Thanks to all of you for a really fascinating session there. So on this final part of the webinar, while Deborah was moderating that session, I've been looking through the questions that have been coming through in the chat section, and my agreement with Deborah beforehand was that she would direct some questions to some people, I would direct them to others. But I'm going to ask her if she doesn't mind if I just breach that, because the first question I wanted to ask was to Anthony and to Esther. And it's a question which came about getting a view from them on how well positioned do they feel the inclusive financial ecosystem is to handle future crises. And it would be great to get a DFI perspective on this. So we've talked about the pandemic. What about future crises? That's the one I'd like to start with.
And as we do that, David, Esther and Anthony, this was a question you and we had all talked about before that you could integrate into David's, which is, and what do you think people sometimes need to know about the DFI world in order for the private sector to best tap the resources and expertise that you can bring into a transaction? So maybe I think we could combine those two.
Ladies first, Esther.
Sure. All right. So, and here I'll just literally pick out a statement that Deborah put in one of the in her blog, which says that timing is everything and likely will determine who survives. That's 100% plagiarism from Deborah's blog, but that speaks exactly to the DFI world, that taking action for DFIs takes time. They tend to need some time to respond, but when they do so in an impactful way. So I think for me, the lesson that is then to the private sector is that we need to invest in data. If we can model out and conduct scenario analysis and make informed inferences like we have now that a crisis could be looming, then we can marshal up the forces early enough to define the kind of tools that are needed, and I know Deborah and David, you're asking about future crisis, but I already see that the COVID pandemic is not happening in isolation, right? So today there is a political crisis happening in Afghanistan, there's one happening in Myanmar, there's an economic crisis happening, as well in Turkey at the same time. And all this are happening while we're still watching what's happening with the pandemic. So as DFIs are taking time, which they do, to respond and come together, it is, in my view, the role of private players to take the lead in deal structuring and call us out, and I'd say call DFIs out and say, that this is the response that is needed, and this is where we would like you to come in. And while you're putting together your required approvals and your required, procedures, we are already looking at this issue and we already know what should be coming in and support us in actually getting there. So it's a matter of timing, it's a matter of knowing that it is coming, and it's a matter of, in my view, for the private sector to take a more leading role here.
Anthony, do you have something to add there before we move on?
I just want to, maybe draw from Mary Rose's blog about, how the pandemic has created this tremendous outpouring of goodwill on the part of investors and investees during the pandemic. And I've kind of witnessed some of that myself, having to manage through some very difficult situations. As Esther was saying, it's not just the pandemic, but we've also seen situations where there's been political upheaval, in certain countries, be it Haiti or Myanmar or Afghanistan, et cetera. And so there's those double whammy situations happening. But, I think, the DFC, we are an important player in this whole microfinance ecosystem. We have about $2.5 billion worth of commitments to microfinance globally. And this pandemic has really kind of pushed us to the limit in terms of, both responding as quickly as we can to, requests for additional funding. And we've been able to put out a record number of new commitments last year, which is incredible to think that, we've committed over $6.5 billion, which in our 25-year history was unprecedented, and it happened, at a time when, people aren't allowed to travel, and we had to do it, through virtual means. So that's pretty amazing. We also, of that, $6.5 billion, we were able to put out $300 million in new commitments just to microfinance, working with trusted partners in the microfinance space. And we responded to an unprecedented number of requests for things like waivers, things like, debt deferrals, debt moratoria, et cetera. And I think, in responding to this crisis, I'm surprised at how quickly and how well people have worked together to kind of address the needs of the microfinance world. And I think, to sort of echo what Esther is saying, we are slower, as a DFI, we are accountable to a number of stakeholders, and we are private sector driven, right? So we respond to projects that come through our front door. We're not putting out projects. We provide funding to proposals that come to us through the front door. So we're responding to the private sector. They're in the driver's seat. So they're the ones that need to initiate the response either to this current crisis, whether it's, insolvency in the future that's coming up, or any future crisis, right? So they're in the driver's seat. They need to come to us and lead the process. And it's no surprise we're slower than the private sector, but we have certain superpowers, if you will, because we have the lowest cost of capital. We can take risks that the private sector can't take on its own. And so, we have an important role to play here. And we can also write larger tickets in many cases. So I think in terms of future crises, we have a really super important role to play.
I'm going to pick up on this and bring Mary Rose into this conversation. Mary Rose, you may have seen a comment and question that Lauren Rodwin has posted, and it echoes something that I think you said in your blog, which is COVID is one of a significant crisis, but we're going to see lots more crises come forward in the future. And we all know that. Climate catastrophes, food insecurity. And I know when you were thinking in your blog and talking about your blog, you really were sort of saying, what can we learn that we can take forward? And so Lauren asked, how well positioned are we to handle future crises? And how do we, what is the quote? Don't let a crisis go unused. I mean, it's, what can we do to take some of these learnings that we're going through? What are your thoughts there?
Well, I think that what I'm starting to do already is, in terms of when I'm looking at new deals, I'm encouraging clients to already start pre-counseling the borrowers, or at a very early stage when we start to see some issues with a borrower. What I'm trying to do is to have clients counsel the borrowers to just say how to proceed with transparency. I'm also thinking that when we're in the process of approving transactions for the lower tier MFIs, we should already, sometimes when you're trying to write the investment memo, you want to sort of emphasize the good things, and that's really good. But if we could also take a look at the information system, or maybe there's too much influence by one individual, or maybe some of the arrangements by which they're executing their model are not formalized sufficiently, and therefore, you know, for example, under COVID, you know, it revealed some weaknesses that what you almost were like, what? How did we not see that? So that's what I'm trying to do. And I think the counseling, like one of the things that we realized recently in one case was that what we thought as creditors, the process was in these bankruptcy proceedings in Mexico was just wrong. And we were kind of thinking that we were being left out and not treated well. So I think it's really about being really mindful and conscious about communicating with people so that they learn crisis management skills on the job. And I don't think it's seminars necessarily. It's almost like weaving all this into the way you interact.
So could I come in with another question which came out of the chat section, and it drills down into this issue of digitization, which we've talked about a little bit, taking things for granted. I think what the comment points out is that fintech is one thing, microfinance is another thing, and it draws a comparison between these community development finance institutions and consumer lending, which are very different areas. So I just wonder if perhaps we could put a question to Andrée about this. Your understanding of the risks of moving, if you go to digitization, you suddenly move into a kind of consumer lending model, and what does that do for your basic microfinance institution provision? So that's the first part of the question, Andrée. The second part is digitization costs a lot of money. Who do you think is going to pay for it?
So I think we need to actually start the conversation by distinguishing between automation and digitization. And really, you know, the goal for microfinance institutions, at least for us, is not to become a consumer lender. That is not the reason that we are in business. Certainly, I do agree that clients need, you know, consumption smoothing on some level, and we've always noted that there's flexibility in some of the purposes that people use their loans for. But what really will move the needle for most microfinance institutions is the automation of a lot of functions that have been handled in a very labor-intensive way in the past. And I think that gets to one of the other comments around the cost of serving microfinance clients. You know, it is in fact, you know, back office functions that really need to be automated and driven much more through technology that is going to deliver the lowering in the cost base that will allow us not only, I can't remember if it was Sizwe, I think, who said this, but, you know, the scale with quality, but also having that greater efficiency in the system. And I think that collectively we tend to focus on the really cool, sexy front end interventions that are actually not as applicable to our clients today. Most of the clients that we serve, for example, in sub-Saharan Africa, yes, will benefit from digitization and will benefit from remote access to their accounts, but they're still facing some pretty fundamental hurdles in terms of connectivity and data cost when it comes to actually using the applications on the front end in order to facilitate their transactions. But there's a lot that can be done on that back end, and that's really, in my view, where the investment is needed today. I hope that's a good answer for you.
There's another sort of theme that has come out both in the questions and I think across the conversation. So I'd like to open this up to any of our speakers who have a point of view on this, which is, and Deborah gave sort of a nod to this, as did some of our development finance institution folks, which is where's creativity in the financial structuring of issues here. We've had a question about what role can subordinated debt play. We had a comment by Deborah about some creative ways to have deferred pricing. You know, when we start to think about, is our toolbox sufficient? What more could be happening? Where are people looking for possible responses to this? And I'll let any of our speakers who sort of feel like they'd like to weigh in on this to go ahead and say something. Mary Rose, I see you just unmuted yourself. Go ahead.
Yeah, so one thing that we have to keep in mind is that some of the creativity, I mean, I am a great supporter of creativity, and we have seen some debt restructuring proposals where we accelerate forgiveness in exchange for early payments. We've considered subordinated debt. One of the issues we faced in Mexico is that a lot of the companies, or several of the companies in this space, have filed for concursos, which is like, I mean, we say Chapter 11, but it's not really. And that has produced some real issues with creativity, because now we're worried if we start doing debt forgiveness or trying to go for subordinated debt, that if there's a filing, we'll be, punished if they file after we reach those agreements. The other thing that you have to keep in mind is, does the instrument work for whatever regulatory purposes, and does it work for legal purposes? And getting the advice to in a jurisdiction where perhaps subordinated debt hasn't existed in the past. So that's some of the challenges with some of the creativity from a legal point of view.
I might, at this point, David, you see another sort of theme of questions that you don't think we have sufficiently addressed, because we have about 4 more minutes, and I am willing to cede any summarizing of this up to let this conversation go, because I think it's more important to hear from our speakers than it is to have me repeat what we've just heard.
There is one question, Deborah, which was about, I think, our high interest rates, which are charged in MFI.
That was
are they justifiable? And maybe Nina, with your economics PhD, you could give us some views on this particular point. Sorry to throw it at you.
Oh, okay, David. I mean, this is this is a tricky one. I mean, of course, interest rates are going to vary within a market, right? Because interest rates are there to compensate for risk, right? So that is how, a financial institution does its business. It's how it makes sure that it covers its own costs by charging an interest rate. Where that fails is where we have non-competitive markets, or where markets are not properly regulated. And I think that's why, firstly, we have a strong focus on client protection, so that, we have to make sure that anyone we're investing in is definitely not charging an exploitative interest rate. And this can happen, right, in microfinance, because these are very segmented markets. People are often, they're not well informed necessarily. They don't, even if other providers exist, people don't know how to go to them. And we also, we try to work with the regulators to make sure that competition is fair as well, right? And I think this was something that I was thinking about when we were talking about the fintechs and the microfinance institutions, right? So I agree in general that, it's not going to be a kind of battle to the death, and probably both will continue to exist. But I think the kind of regulatory piece, making sure that competition is fair between these, and part of that is also the consumer protection side, and making sure that people are fairly informed so that they know what they're taking on, and they're not being exploited. So I hope that slightly answered your question there, David.
Great answer. Thanks very much, Nina. Appreciate it.
Yes, and so we are now 1 minute away from ending this. So let me first just say a huge thank you. This was a heavy lift for our speakers. We not only made sure that they read the paper, but they then had to think about responses to it. And then after, as a reward for that, we said, come and talk about it. But we really appreciate everyone who participated and the thoughtfulness that you brought to this this. We also really appreciate the audience that we've had for this. It was wide-ranging. This will be, as you know, this was recorded, so this video will be on the CGAP website. So for colleagues and friends of yours who did not have a chance to attend, please let them know. There will be one very last blog that David and I will put together, which will be some of the summarizing of some of the bigger themes that came out of this. But thank you all very much for everything you did today and have been doing in the lead up to this. We really appreciate it. And I think I can say this on behalf of CGAP. This is the kind of intellectual, honest conversation that is really important to the health of our sector. So thank you, everybody.
Thank you.
Thank you.
Thank you.
Yeah.